Question 1. Regulatory review indicates that a client, who is a significant investor in a particular industry sector, has inquired about potential upcoming regulatory changes that could materially impact that sector. The client is seeking to understand how these changes might affect their portfolio. The employee has access to preliminary, non-public information regarding the specifics of these impending regulatory changes, which, if acted upon, could allow the client to make significant trading decisions before the information becomes public. What is the most appropriate course of action for the employee? Option A. Advise the client on specific trading strategies to mitigate potential losses or capitalize on anticipated market movements based on the non-public information. Option B. Immediately escalate the client's inquiry and the employee's knowledge of the non-public information to the firm's compliance department for guidance. Option C. Inform the client directly about the specific details of the upcoming regulatory changes and their potential impact on their investments. Option D. Provide the client with a general overview of potential regulatory shifts in the industry without disclosing any specific non-public details. The correct answer is B. Immediately escalate the client's inquiry and the employee's knowledge of the non-public information to the firm's compliance department for guidance. Explanation. This scenario presents a professional challenge due to the inherent conflict between client needs and regulatory compliance, particularly concerning the disclosure of material non-public information. The firm's duty to its clients must be balanced against the strict prohibitions against insider trading. Careful judgment is required to navigate this delicate situation without violating securities laws or ethical standards. The correct approach represents best professional practice because it prioritizes adherence to the Bank Secrecy Act, BSA, and the Securities Exchange Act of 1934, specifically Rule 10b-5, which prohibits fraud and manipulation in connection with the purchase or sale of securities. By immediately escalating the situation to the compliance department, the employee ensures that the firm can take appropriate steps to prevent any potential misuse of material non-public information, thereby safeguarding the integrity of the market and protecting the firm from regulatory penalties and reputational damage. This proactive and compliant action aligns with the firm's fiduciary duties and ethical obligations. An incorrect approach that involves directly informing the client about the potential negative impact of the upcoming regulatory change before it is publicly announced would constitute a violation of insider trading laws. This is because the information is material, non-public, and could be used by the client to unfairly profit or avoid losses in the market. Another incorrect approach, such as ignoring the client's inquiry or downplaying the significance of the regulatory change without proper internal review, would be a failure to act diligently and could lead to the firm being complicit in a violation if the client subsequently acts on the unaddressed information. A third incorrect approach, attempting to interpret the regulatory change and advise the client on its specific implications without explicit authorization and expertise from the compliance department, risks providing inaccurate or incomplete information, which could still lead to market manipulation or a breach of fiduciary duty. Professionals should employ a decision-making framework that begins with identifying potential regulatory or ethical conflicts. This involves recognizing when information or a client request might trigger concerns related to insider trading, market manipulation, or breaches of confidentiality. The next step is to consult internal policies and procedures, which typically outline protocols for handling sensitive information and client inquiries. Crucially, if there is any doubt or ambiguity, the professional must escalate the matter to the appropriate internal department, such as compliance or legal, for guidance and resolution. This ensures that actions taken are in full compliance with all applicable laws and regulations and uphold the highest ethical standards. Question 2. The risk matrix shows a new investment product with a moderate likelihood of operational failure and a high potential impact on client assets, but the projected revenue is substantial. The product development team is eager to launch within the quarter, which approach best aligns with regulatory expectations and professional best practices for Wells Fargo in the U.S. Option A. Delay the product launch until a comprehensive risk assessment is completed. All identified high-impact risks are adequately mitigated with robust controls, and formal approval is obtained from all relevant governance committees. Option B. Proceed with the launch after implementing basic operational safeguards, with a plan to address any emerging issues post-launch. Option C. Focus solely on the projected revenue and market demand, assuming that the risk matrix is overly conservative and the identified risks are unlikely to materialize. Option D. Launch the product immediately to capture market opportunity and address the risk matrix findings as they become apparent through ongoing monitoring. The correct answer is B. Proceed with the launch after implementing basic operational safeguards with a plan to address any emerging issues post-launch. Explanation. Scenario analysis. This scenario presents a common challenge in financial institutions where a new product, while potentially profitable, carries inherent risks that may not be fully understood or adequately mitigated by existing controls. The challenge lies in balancing the drive for innovation and revenue generation with the imperative to protect the firm and its clients from undue harm, ensuring compliance with regulatory expectations for risk management and product governance. The pressure to launch quickly can lead to shortcuts in due diligence, creating a professionally difficult situation requiring careful judgment. Correct approach analysis. The correct approach involves a thorough, multi-stage review process that prioritizes risk identification, assessment, and mitigation before product launch. This aligns with best practices mandated by U.S. banking regulations, such as those outlined by the Office of the Comptroller of the Currency (OCC) and the Federal Reserve, which emphasize robust risk management frameworks, including comprehensive product risk assessments and strong internal controls. Specifically, regulatory guidance often requires a formal product approval process that includes input from various departments, e.g., risk, compliance, legal, operations, to ensure all potential risks are identified and addressed. This approach ensures that the product is not only commercially viable, but also compliant and operationally sound, safeguarding the firm's reputation and financial stability. Incorrect approach is analysis. One incorrect approach would be to proceed with the launch based on the initial risk assessment, assuming that the identified risks are manageable without further investigation or control enhancements. This fails to meet the regulatory expectation for a proactive and comprehensive risk management approach. It could lead to significant operational failures, financial losses, and reputational damage, potentially violating regulations that require institutions to have adequate systems and controls in place to manage risks associated with new products. Another incorrect approach would be to defer the full risk assessment to a later stage, post-launch, with the intention of addressing issues as they arise. This is a direct contravention of regulatory principles that emphasize upfront risk assessment and mitigation. It exposes the firm to significant unmanaged risks from the outset, increasing the likelihood of regulatory scrutiny, fines, and customer complaints. Such a reactive stance is not considered best practice and demonstrates a disregard for the firm's risk appetite and control environment. A third incorrect approach would be to prioritize the potential revenue generation over the identified risks, pushing for a launch despite significant concerns raised by the risk and compliance teams. This demonstrates a failure in ethical conduct and corporate governance, potentially leading to a breach of fiduciary duty and a violation of regulations that require senior management to oversee risk-taking activities responsibly. It undermines the integrity of the risk management framework and can result in severe consequences for the firm and its stakeholders. Professional reasoning. Professionals should adopt a structured decision-making process that begins with a clear understanding of the firm's risk appetite and regulatory obligations. When evaluating new products, this involves a systematic process of risk identification, assessment, and mitigation. Key steps include engaging all relevant stakeholders early in the process, conducting thorough due diligence, developing robust controls, and obtaining formal approval from appropriate governance bodies before launch. If significant risks remain unmitigated, the professional decision is to delay or halt the launch until adequate controls are in place, prioritizing compliance and risk management over short-term gains. Question 3. The risk matrix shows a moderate likelihood of a client requesting non-public information about upcoming product changes that could impact their investment strategy. A long-standing, high-net-worth client, who is also a personal acquaintance of a senior executive, has made such a request directly to you, a relationship manager. You are aware that the information is not yet publicly disseminated and is considered proprietary. Which of the following actions best aligns with regulatory expectations and ethical best practices for Wells Fargo employees in the U.S.? Option A. Fulfill the client's request by providing the information, as they are a valuable client and a personal acquaintance of a senior executive, and it is important to maintain good relationships. Option B. Share the information with the client, but only after obtaining verbal confirmation from the senior executive who knows the client personally. Option C. Inform the client that you cannot provide any non-public information due to regulatory restrictions and company policy, without further discussion or escalation. Option D. Document the client's request and immediately escalate it to your manager and the compliance department for guidance on how to proceed, ensuring no information is shared until approved. The correct answer is D. Document the client's request and immediately escalate it to your manager and the compliance department for guidance on how to proceed, ensuring no information is shared until approved. Explanation. This scenario is professionally challenging because it requires balancing client needs with regulatory obligations and internal policies, particularly when dealing with potentially sensitive information and the perception of preferential treatment. The need for careful judgment stems from the potential for conflicts of interest and the importance of maintaining client trust and regulatory compliance. The correct approach represents best professional practice because it prioritizes transparency and adherence to established policies. By documenting the request and seeking internal guidance, the employee demonstrates a commitment to ethical conduct and regulatory compliance. This proactive step ensures that any action taken is in line with Wells Fargo's policies and relevant U.S. banking regulations, such as those enforced by the Office of the Comptroller of the Currency (OCC) or the Consumer Financial Protection Bureau (CFPB), which emphasize fair dealing and the prevention of conflicts of interest. It also safeguards the firm from potential reputational damage and regulatory scrutiny. An incorrect approach that involves directly fulfilling the request without proper authorization or documentation would be professionally unacceptable. This could lead to regulatory violations, such as breaches of fair lending practices or insider trading concerns, depending on the nature of the information shared. It also creates a significant ethical failure by potentially offering preferential treatment, undermining the principle of treating all clients equitably. Furthermore, failing to document the interaction and the decision-making process leaves the firm vulnerable to accusations of impropriety and makes it impossible to demonstrate compliance if audited. Another incorrect approach, such as dismissing the request outright without considering the client's needs or the potential for a legitimate business reason, could be seen as poor client service and potentially lead to lost business. While it avoids regulatory risk, it fails to meet the professional standard of client engagement and problem solving. The professional reasoning process for similar situations should involve a clear understanding of the firm's code of conduct and relevant regulatory requirements. When faced with a request that seems unusual or could create a conflict, the employee should first assess the nature of the request and its potential implications. The next step is to consult internal policies and procedures. If the situation remains unclear or falls into a gray area, escalating the matter to a supervisor or compliance department for guidance is crucial. This ensures that decisions are made with the full awareness of potential risks and in accordance with established protocols, thereby protecting both the individual and the firm. Question 4. Implementation of a new client onboarding process at Wells Fargo has revealed a long-standing client, known for their consistent and predictable financial activities, is requesting a series of complex, high-value international wire transfers to a newly established offshore entity with no discernible business purpose. The client has been evasive when asked for details about the nature of these transactions. What is the most appropriate course of action for the financial advisor? Option A. Inform the client that the transactions are too unusual and decline to process them without further internal consultation. Option B. Directly question the client aggressively about the source of funds and the purpose of the transfers to pressure them for information. Option C. Proceed with the wire transfers as requested, assuming the client has legitimate reasons for the transactions. Option D. Immediately escalate the matter to the firm's anti-money laundering (AML) compliance department for review and guidance. The correct answer is D. Immediately escalate the matter to the firm's anti-money laundering (AML) compliance department for review and guidance. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's stated desire and the firm's regulatory obligations and ethical responsibilities. The advisor must navigate the client's potentially uninformed or ill-advised request while upholding their fiduciary duty and adhering to the Bank Secrecy Act (BSA) and its associated anti-money laundering AML regulations. The pressure to satisfy a client's request, especially from a long-standing or high-value client, can create a temptation to overlook red flags, making careful judgment and adherence to policy paramount. Correct approach analysis. The correct approach demonstrates best professional practice by prioritizing regulatory compliance and ethical conduct over immediate client satisfaction. It involves escalating the situation to the appropriate internal compliance department. This aligns with the BSA's requirement for financial institutions to establish and maintain effective AML programs, which include procedures for identifying and reporting suspicious activity. By involving compliance, the firm ensures that the transaction is reviewed by individuals trained to detect potential money laundering or other illicit financial activities, thereby fulfilling its legal and ethical obligations to prevent financial crime and protect the integrity of the financial system. This proactive escalation is a cornerstone of responsible financial stewardship. Incorrect approaches analysis. One incorrect approach involves proceeding with the transaction without further inquiry. This directly violates the spirit and letter of the BSA and AML regulations. It demonstrates a failure to implement an effective AML program, as it bypasses the necessary due diligence and suspicious activity monitoring. Ethically, it represents a dereliction of duty by potentially facilitating illicit financial flows. Another incorrect approach is to directly question the client about the source of funds in a manner that could tip them off to suspicion. While due diligence is required, the method of inquiry is critical. Directly confronting a client without proper internal procedures can lead to obstruction of an investigation, destruction of evidence, or the client ceasing to bank with the institution, thereby hindering the firm's ability to fulfill its regulatory obligations. This approach can also damage the client relationship unnecessarily if the transaction is ultimately legitimate. A third incorrect approach is to dismiss the client's request as unusual, but proceed without any internal reporting or further investigation. This is a failure to exercise reasonable diligence and to adhere to the firm's AML policies. The unusual nature of the transaction is a red flag that warrants investigation, not dismissal. Ignoring such flags can lead to significant regulatory penalties and reputational damage for the firm. Professional reasoning. Professionals in this situation should follow a structured decision-making process. First, identify any potential red flags or deviations from normal client behavior or transaction patterns. Second, consult the firm's internal policies and procedures, particularly those related to AML and suspicious activity reporting. Third, if the situation warrants, escalate the matter to the designated compliance or risk management department, providing all relevant details. Fourth, follow the guidance provided by the compliance department. This systematic approach ensures that decisions are made in accordance with regulatory requirements, ethical standards, and the firm's operational framework, protecting both the individual professional and the institution. Question 5. System analysis indicates that a Wells Fargo personal banker is assisting a long-time acquaintance with a large cash deposit into their checking account. The acquaintance explains the funds are from the sale of a classic car, a hobby they have mentioned in the past. However, the amount of the deposit is significantly larger than the typical transaction volume for this customer, and the customer appears unusually nervous. The banker is considering processing the deposit directly, given their personal relationship and the seemingly plausible explanation. Option A. Ignore the unusual nature of the deposit and proceed with the transaction, assuming it is a one-time event. Option B. Process the deposit as requested, noting the customer's explanation in the transaction notes, as the customer is a known acquaintance. Option C. Escalate the transaction to the Bank Secrecy Act, BSA, Compliance Department for further review and investigation. Option D. Advise the customer on how to break the deposit into smaller amounts over several days, to avoid triggering any reporting requirements. The correct answer is C. Escalate the transaction to the Bank Secrecy Act, BSA Compliance Department for further review and investigation. Explanation. Scenario analysis. This scenario presents a common challenge in financial services where an employee, even with good intentions, might inadvertently facilitate a violation of anti-money laundering AML regulations. The challenge lies in identifying the subtle indicators of suspicious activity and understanding the firm's obligation to report, even when the customer's explanation seems plausible on the surface. The employee's personal relationship with the customer adds a layer of complexity, potentially influencing their judgment and making them less likely to question the transaction. Correct approach analysis. The correct approach is to escalate the transaction for further review by the Bank Secrecy Act (BSA) Compliance Department. This aligns with Wells Fargo's regulatory obligations under the USA Patriot Act and FinCEN guidance, which mandate robust AML programs. The BSA Compliance Department is specifically trained to identify and investigate suspicious activities that may indicate money laundering or terrorist financing. Escalation ensures that the transaction is assessed by individuals with the expertise and authority to make a determination based on regulatory requirements, thereby protecting the firm from potential penalties and upholding its commitment to financial integrity. Incorrect approaches analysis. One incorrect approach is to process the transaction without further inquiry because the customer is a long-time acquaintance, and the explanation for the large cash deposit seems reasonable. This fails to adhere to the Know Your Customer (KIC) principles embedded in AML regulations. The fact that the customer is known does not exempt them from scrutiny, especially when the transaction deviates from their expected activity. This approach risks overlooking red flags and could lead to the firm being used as a conduit for illicit funds, violating the spirit and letter of AML laws. Another incorrect approach is to advise the customer on how to structure their deposits to avoid triggering reporting thresholds. This is a direct violation of AML regulations, specifically the prohibition against structuring. Structuring is a common money laundering technique, and assisting in it, even indirectly, makes the employee complicit in the illegal activity. This action would expose the employee and Wells Fargo to severe legal and financial repercussions, including significant fines and reputational damage. A third incorrect approach is to dismiss the transaction as an anomaly without any documentation or internal notification. This demonstrates a lack of diligence and a failure to follow established internal control procedures for suspicious activity. Even if the transaction ultimately proves to be legitimate, the failure to document the assessment and escalation process leaves the firm vulnerable. Regulatory bodies expect firms to have a systematic process for identifying, reporting, and investigating suspicious activity, and this approach bypasses that critical safeguard. Professional reasoning. Professionals in financial institutions must prioritize regulatory compliance and ethical conduct above all else. When faced with a situation that raises even the slightest suspicion of illicit activity, the decision-making process should involve 1. Recognizing potential red flags, e.g., unusual transaction amounts, cash-intensive business, customers' explanation not aligning with known activity. 2. Consulting internal policies and procedures for handling suspicious activity. 3. Escalating the matter to the appropriate compliance department for expert review. 4. Documenting all actions taken and decisions made. This structured approach ensures that regulatory obligations are met, risks are mitigated, and the firm's integrity is maintained. Question 6. Stakeholder feedback indicates a client with whom you have a long-standing relationship wishes to deposit a significant sum of cash into their account. The client states the funds are from a recent sale of a personal asset, but is hesitant to provide any documentation to support this claim, citing privacy concerns and their history with the bank. As a financial advisor, what is the most appropriate course of action to balance client service with regulatory compliance? Option A. Proceed with the deposit as requested, assuring the client that their long-standing relationship with the bank is sufficient assurance for the source of funds, and address any potential documentation requirements later if prompted by internal systems. Option B. Accept the client's verbal assurance regarding the source of funds and process the deposit, noting their privacy concerns in the client file without requesting any supporting documentation. Option C. Immediately refuse the deposit and inform the client that their request is suspicious and cannot be accommodated due to potential money laundering concerns, without attempting to gather any further information. Option D. Politely explain that, while you value their business, regulatory requirements necessitate verification of the source of funds for large cash deposits, and request specific documentation such as a bill of sale or proof of asset ownership. If the client remains unwilling to provide documentation, inform them that the deposit cannot be processed at this time, and escalate the matter internally to the compliance department for further guidance. The correct answer is D. Politely explain that while you value their business, Regulatory requirements necessitate verification of the source of funds for large cash deposits and request specific documentation such as a bill of sale or proof of asset ownership. If the client remains unwilling to provide documentation, inform them that the deposit cannot be processed at this time and escalate the matter internally to the compliance department for further guidance. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between client requests and regulatory obligations. A financial advisor must navigate the delicate balance of client satisfaction and adherence to strict compliance rules, particularly concerning the prevention of money laundering. The pressure to maintain a client relationship can be significant, but failing to uphold regulatory standards can lead to severe penalties for both the individual and the institution, as well as reputational damage. The advisor must exercise sound judgment and prioritize compliance over immediate client appeasement. Correct approach analysis. The correct approach involves a thorough, documented investigation into the source of funds, coupled with a refusal to process the transaction until satisfactory evidence is provided. This aligns directly with the Bank Secrecy Act (BSA) and its implementing regulations, such as the Customer Identification Program (CIP) and Suspicious Activity Report (SAR) requirements. Wells Fargo, as a financial institution, has a legal and ethical obligation to implement robust anti-money laundering (AML) controls by requesting documentation and escalating the matter internally if concerns persist. The advisor is fulfilling their duty to identify and report suspicious activity, thereby protecting the institution and the financial system from illicit use. This proactive stance demonstrates a commitment to regulatory compliance and ethical conduct. Incorrect approach is analysis. Proceeding with the transaction without sufficient verification of the source of funds is a direct violation of AML regulations. This failure to conduct adequate due diligence can facilitate money laundering and other financial crimes, exposing Wells Fargo to significant legal and financial penalties, including fines and reputational damage. It also represents a breach of ethical duty to act in the best interest of the institution and the integrity of the financial system. Accepting the client's verbal assurance without seeking any corroborating documentation is insufficient under regulatory requirements. While building client trust is important, it cannot supersede the mandatory compliance procedures designed to prevent financial crime. This approach demonstrates a lack of diligence and a potential willingness to overlook red flags, which is a serious regulatory and ethical failing. Escalating the issue to a supervisor without first attempting to gather basic, necessary information from the client is inefficient and may indicate a lack of understanding of the advisor's own responsibilities. While supervisors are there for guidance, advisors are expected to perform initial due diligence. This approach, while not directly facilitating illicit activity, shows a lack of proactive engagement with compliance responsibilities. Professional reasoning. Professionals in financial services must adopt a risk-based approach to client interactions. When faced with unusual or potentially suspicious transactions, the decision-making process should prioritize regulatory compliance and institutional policy. This involves 1. Understanding the specific regulatory requirements, e.g., BSA CIP SAR. 2. Gathering all necessary information from the client to verify the transaction and source of funds. 3. Documenting all interactions and findings meticulously. 4. Escalating concerns to appropriate internal channels, e.g., compliance department supervisor, if red flags persist or if the client is uncooperative. 5. Never proceeding with a transaction that raises significant compliance concerns without proper authorization and documentation. This systematic approach ensures that client relationships are managed responsibly while upholding the highest standards of regulatory adherence and ethical conduct. Question 7. The evaluation methodology shows that when a Wells Fargo employee receives a request for customer financial information from a colleague in a different department, and the employee believes the colleague has a legitimate business need, what is the most appropriate course of action to ensure regulatory compliance and protect customer data? Option A. Share the customer's full account details via unencrypted email to the colleague, assuming their departmental role grants them implicit access. Option B. Forward the customer's personal identifiable information directly to the colleague's personal email address for convenience. Option C. Discuss the customer's specific financial situation and account numbers verbally in a public or semi-public area of the office. Option D. Consult the company's compliance department to confirm the appropriate and secure method for sharing the requested information, ensuring only necessary data is disclosed. Correct answer is D. Consult the company's compliance department to confirm the appropriate and secure method for sharing the requested information, ensuring only necessary data is disclosed. Explanation. Scenario analysis. This scenario presents a common challenge in financial services where an employee, even with good intentions, may inadvertently create a compliance risk by sharing sensitive information. The professional challenge lies in balancing the need for collaboration and efficiency with the strict requirements of data privacy and confidentiality mandated by regulatory bodies like the Consumer Financial Protection Bureau, CFPB, and the Office of the Comptroller of the Currency, OCC, which govern Wells Fargo's operations in the U.S. Misjudging the appropriateness of information sharing can lead to significant regulatory penalties, reputational damage, and loss of customer trust. Correct approach analysis. The correct approach involves recognizing that while a colleague may have a legitimate business need for information, the method of sharing must adhere to established protocols designed to protect customer data. This means utilizing secure, authorized channels for data transfer and ensuring that only the minimum necessary information is shared. This aligns with the principles of data minimization and secure data handling, which are fundamental to regulations such as the Gramm-Leach-Bliley Act, GLBA, and various state data privacy laws. By seeking guidance from the compliance department, the employee demonstrates a commitment to upholding regulatory standards and ethical conduct, which is best professional practice. Incorrect approach is analysis. Sharing the customer's full account details via unencrypted email to a colleague, even if they are in another department, represents a significant regulatory and ethical failure. This violates GLBA Safeguards Rule, which mandates the protection of customer information. It also breaches internal company policies designed to prevent data breaches. This approach demonstrates a disregard for data security protocols and a lack of understanding of the potential consequences of unauthorized data disclosure. Forwarding the customer's personal identifiable information, PI, directly to the colleague's personal email address is an even more egregious violation. Personal email accounts are generally not considered secure for business-related sensitive data and are outside the company's control and monitoring capabilities. This action exposes the customer's data to a much higher risk of compromise and is a clear violation of data privacy regulations and ethical obligations. Discussing the customer's specific financial situation and account numbers verbally in a public or semi-public area, such as a break room or hallway, is also a failure. While not a data transmission in the digital sense, it constitutes an unauthorized disclosure of confidential information. This violates the expectation of privacy for customers and can lead to reputational damage for the firm if overheard by unauthorized individuals. It demonstrates a lack of awareness regarding the importance of maintaining confidentiality in all professional interactions. Professional reasoning. Professionals in the financial services industry must adopt a proactive and risk-aware mindset. When faced with a request for sensitive information, the decision-making process should involve 1. Identifying the nature of the information requested and its sensitivity. 2. Determining if the requester has a legitimate business need and the proper authorization to access such information. 3. Consulting internal policies and procedures regarding data sharing and access. 4. If there is any doubt or ambiguity, seeking clarification and guidance from the compliance department or a supervisor before proceeding. This structured approach ensures that all actions are compliant with regulations and ethical standards, safeguarding both the customer and the organization. Question 8. Investigation of a scenario where a Wells Fargo financial advisor is approached by a long-term client who expresses a strong desire to invest a significant portion of their portfolio in a highly speculative, illiquid alternative investment product that the advisor believes is not suitable for the client's stated retirement goals and risk tolerance. The client is insistent, citing a friend's purported success with the product. Option A. Recommend a different, more conservative investment that the advisor believes is appropriate, without fully explaining the rationale or addressing the client's specific interest in the alternative product. Option B. Explain to the client, in detail, why the proposed investment is not suitable based on their financial profile and investment objectives, and offer alternative investments that align with their goals and risk tolerance, documenting all discussions thoroughly. Option C. Investigate the alternative investment product thoroughly to understand its potential benefits and risks, and if it appears to have any merit, recommend it to the client despite initial suitability concerns. Option D. Proceed with the investment as requested by the client, assuming the client understands the risks and is making an informed decision to maintain client satisfaction. The correct answer is B. Explain to the client in detail why the proposed investment is not suitable based on their financial profile and investment objectives, and offer alternative investments that align with their goals and risk tolerance, documenting all discussions thoroughly. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's stated preference and the firm's regulatory obligations. A financial advisor must navigate the client's desire for a specific, potentially unsuitable investment with the fiduciary duty to act in the client's best interest and comply with regulations designed to protect investors. The advisor's judgment is critical in balancing client satisfaction with regulatory adherence and ethical responsibility. Correct approach analysis. The correct approach demonstrates best professional practice by prioritizing regulatory compliance and the client's best interest over immediate client satisfaction. This aligns with the principles of suitability and fiduciary duty mandated by U.S. securities regulations, such as those enforced by the SEC and FINRA. Specifically, the advisor must conduct a thorough suitability assessment, considering the client's financial situation, investment objectives, risk tolerance, and time horizon. If the recommended investment does not meet these criteria, the advisor has a regulatory and ethical obligation to explain these concerns clearly to the client and recommend alternative investments that are suitable. This approach upholds the integrity of the financial advisory profession and protects the client from potential harm. Incorrect approach is analysis. Recommending the investment without further inquiry, despite suitability concerns, represents a failure to adhere to suitability rules and potentially a breach of fiduciary duty. This could lead to regulatory sanctions, client litigation, and reputational damage for both the advisor and Wells Fargo. It prioritizes sales over client well-being. Pushing the client to accept the advisor's recommendation without fully understanding the client's rationale for the specific investment is also problematic. While the advisor may believe their recommendation is superior, failing to explore the client's perspective can lead to misunderstandings and a breakdown of trust. It also misses an opportunity to identify any underlying client needs or preferences that might be addressed by a suitable alternative. Ignoring the client's request and proceeding with a completely different investment strategy without discussion is also a failure. While the advisor has a duty to recommend suitable investments, completely disregarding a client's stated interest without explanation can damage the client relationship and may not fully address the client's underlying investment goals, even if the alternative is technically suitable. Professional reasoning. Professionals should employ a structured decision-making process that begins with understanding the client's needs and objectives. This is followed by a thorough assessment of suitability based on regulatory requirements and firm policies. When a discrepancy arises between client preference and suitability, the professional must engage in open and transparent communication with the client, explaining the rationale behind their recommendations and any concerns. The ultimate decision should be based on a combination of regulatory compliance, ethical considerations, and the client's best interests, even if it means not fulfilling the client's initial request. Question 9. What factors determine the appropriateness of an investment recommendation for a client within the Wells Fargo regulatory framework? Option A. The historical performance of an investment without considering current market dynamics or evolving regulatory guidelines. Option B. The popularity of an investment strategy among other clients, assuming it implies general acceptability. Option C. A comprehensive assessment of the client's financial situation, risk tolerance, investment objectives, and adherence to all relevant U.S. federal and state securities laws and internal Wells Fargo compliance policies. Option D. The client's expressed desire for the highest possible short-term returns, regardless of underlying risks or regulatory considerations. The correct answer is C. A comprehensive assessment of the client's financial situation, risk tolerance, investment objectives, and adherence to all relevant U.S. federal and state securities laws and internal Wells Fargo compliance policies. Explanation. Scenario analysis. This scenario presents a professional challenge where a financial advisor must navigate the complex landscape of regulatory compliance while advising a client on investment strategies. The challenge lies in balancing the client's stated financial goals with the advisor's fiduciary duty and the stringent requirements of the Wells Fargo compliance framework, which is governed by U.S. federal and state regulation, as well as internal company policies. Misinterpreting or overlooking any of these can lead to significant legal, financial, and reputational damage for both the advisor and Wells Fargo. The advisor must exercise careful judgment to ensure all advice is not only suitable for the client, but also fully compliant with all applicable rules. Correct approach analysis. The correct approach emphasizes a thorough understanding of the client's financial situation, risk tolerance, and investment objectives, coupled with a comprehensive review of relevant regulatory requirements and internal Wells Fargo policies. This aligns with the principles of Know Your Customer (KIC) and suitability, which are cornerstones of financial advisory regulations in the U.S. e.g., SEC rules, FINRA rules. By documenting the client's profile and the rationale for recommendations, the advisor demonstrates adherence to fiduciary standards and provides a defensible record in case of future scrutiny. This proactive and documented approach ensures that client interests are prioritized while maintaining regulatory compliance. Incorrect approach is analysis. One incorrect approach involves prioritizing the client's immediate desire for high returns without adequately assessing the associated risks or regulatory limitations. This could lead to recommendations that are unsuitable for the client's risk profile and may violate regulations like FINRA Rule 2111, suitability, which mandates that firms have a reasonable basis to believe a recommended transaction or investment strategy is suitable for a customer. Another incorrect approach is to solely rely on past performance of investments without considering current market conditions or regulatory changes. This overlooks the dynamic nature of financial markets and regulatory environments, potentially exposing the client to undue risk and failing to meet compliance obligations that require forward-looking assessments. A third incorrect approach is to assume that a recommendation is compliant simply because it is a common or popular investment strategy. Regulatory compliance is not determined by popularity, but by adherence to specific legal and policy frameworks. This approach neglects the due diligence required to confirm that the strategy meets all applicable suitability and regulatory requirements for the specific client. Professional reasoning. Professionals should adopt a systematic decision-making process that begins with a deep understanding of the client's unique circumstances. This should be followed by a thorough review of all applicable regulations, federal, state, and self-regulatory organization rules, and internal company policies. Any recommendation must be clearly documented, with a clear rationale linking the client's profile to the proposed strategy and demonstrating compliance. In situations of uncertainty, seeking guidance from compliance departments or legal counsel is a critical step. This structured approach ensures that client best interests are served while upholding the highest standards of regulatory and ethical conduct. Question 10. When evaluating the onboarding process for new clients at a U.S.-based financial institution, and a client is eager to open an account quickly to begin making transactions, what is the absolute priority that must be upheld regarding customer identification? Option A. Expediting the account opening process by relying on the client's self-provided information to meet service-level agreements. Option B. Skipping certain verification steps for clients deemed low risk to improve onboarding efficiency. Option C. Assuming the client's identity is verified if they have a prior relationship with another reputable financial institution. Option D. Ensuring the client's identity is thoroughly verified according to the Bank Secrecy Act and USA Patriot Act regulations, even if it delays the account opening. The correct answer is D. Ensuring the client's identity is thoroughly verified according to the Bank Secrecy Act and USA Patriot Act regulations, even if it delays the account opening. Explanation. Scenario analysis. This scenario presents a common challenge in financial services, balancing the need for efficient client onboarding with the stringent requirements of the Bank Secrecy Act, BSA, and the USA Patriot Act. The pressure to meet service-level agreements for account opening times can create a temptation to cut corners on Customer Identification Program (CIP) procedures. However, failing to adequately verify customer identity poses significant risks, including facilitating money laundering, terrorist financing, and other illicit activities, which can lead to severe regulatory penalties, reputational damage, and loss of customer trust. The professional challenge lies in adhering strictly to regulatory mandates while striving for operational efficiency. Correct approach analysis. The correct approach emphasizes the absolute priority of regulatory compliance over speed. This aligns directly with the core principles of the BSA and the USA Patriot Act, which mandate robust CIP procedures for all financial institutions. Specifically, Section 326 of the USA Patriot Act requires financial institutions to establish and maintain procedures for verifying the identity of customers. This includes obtaining, verifying, and recording information that allows for the identification of each customer. Prioritizing thorough CIP checks ensures that the institution is not inadvertently enabling financial crimes, thereby upholding its legal and ethical obligations. This approach demonstrates a commitment to risk management and regulatory adherence, which are foundational to maintaining the integrity of the financial system and the institution's standing. Incorrect approach is analysis. One incorrect approach involves relying solely on a customer's self-provided information without independent verification. This directly violates the requirement to verify customer identity. The BSA and USA Patriot Act explicitly state that financial institutions must take reasonable steps to verify the identity of customers using documents, non-documentary methods, or a combination of both. Failing to do so leaves the institution vulnerable to opening accounts for individuals using fraudulent identities, which is a primary concern for regulators. Another incorrect approach is to expedite account opening by skipping certain verification steps for customers deemed low risk, without a documented, regulator-approved risk-based approach that still meets minimum CIP requirements. While risk-based approaches are permitted, they must still ensure that the core identity verification requirements are met. Simply deeming someone low risk and bypassing essential verification steps is a failure to comply with the spirit and letter of the law, potentially allowing illicit actors to slip through the cracks. A third incorrect approach is to assume that a customer's existing relationship with another reputable financial institution automatically satisfies the CIP requirements. While a prior relationship might inform risk assessment, it does not absolve the current institution from its own independent obligation to verify the customer's identity according to its own established CIP procedures. Each financial institution has a direct responsibility to its regulators to ensure its own compliance. Professional reasoning. Professionals in this situation should first understand that regulatory compliance is non-negotiable. The decision-making process should begin with a clear understanding of the specific CIP requirements outlined in the BSA and USA Patriot Act. When faced with a conflict between speed and compliance, the professional should consult the institution's internal policies and procedures, which should be designed to align with regulatory expectations. If there is ambiguity or pressure to deviate from established procedures, the professional should escalate the issue to their supervisor or the compliance department. The ultimate goal is to implement a process that is both compliant and as efficient as possible, but compliance must always take precedence. This involves proactive risk assessment and robust verification methods that are consistently applied. Question 11. System analysis indicates that a new client is attempting to open a high-value business account with Wells Fargo. During the onboarding process, the client provides a valid government-issued identification, but is unable to produce the required secondary identification documents due to them being lost in transit. The client expresses urgency to open the account immediately to facilitate an imminent business transaction. The relationship manager, wanting to secure the client's business and believing the client to be legitimate, considers waiving the secondary identification requirement and proceeding with the account opening based on the client's verbal assurance and the primary ID. What is the most appropriate course of action for the relationship manager in this situation, adhering strictly to U.S. regulatory frameworks and Wells Fargo's internal compliance guidelines? Option A. Accept the client's verbal assurance as sufficient verification and proceed with the account opening, noting the missing documents in the client's file. Option B. Escalate the situation to the Wells Fargo Compliance Department for guidance on how to proceed, potentially exploring alternative verification methods if approved by compliance. Option C. Inform the client that the account cannot be opened until all required secondary identification documents are provided, regardless of the urgency. Option D. Proceed with opening the account using only the primary identification, documenting the client's explanation for the missing secondary documents. The correct answer is B. Escalate the situation to the Wells Fargo Compliance Department for guidance on how to proceed, potentially exploring alternative verification methods if approved by compliance. Explanation. Scenario analysis. This scenario presents a common challenge in financial services where an employee, in an effort to expedite a process and potentially secure a client's business, bypasses established internal controls. The professional challenge lies in balancing the desire for efficiency and client satisfaction with the imperative to adhere to regulatory requirements designed to prevent financial crime. The employee's actions, while seemingly well-intentioned from a client service perspective, create significant compliance risks for Wells Fargo. Correct approach analysis. The correct approach involves recognizing that the client's request, while potentially legitimate, triggers specific regulatory obligations under the Bank Secrecy Act, BSA, and its implementing regulations, particularly those related to Customer Identification Program, CIP, requirements and suspicious activity reporting, SAR obligations. A financial institution has a legal and ethical duty to verify the identity of its customers and to monitor transactions for suspicious activity. Escalating the situation to the compliance department, even if it delays the onboarding process, ensures that these regulatory requirements are met. This upholds the principle of Know Your Customer, KIC, and demonstrates a commitment to preventing money laundering and other illicit financial activities, which is a cornerstone of regulatory compliance for institutions like Wells Fargo. Incorrect approaches analysis. One incorrect approach involves proceeding with the account opening without the required documentation. This directly violates CIP requirements under the USA Patriot Act, which mandates that financial institutions obtain and verify specific information about customers. Failure to do so leaves the institution vulnerable to being used for illicit purposes and can result in severe penalties, including fines and reputational damage. Another incorrect approach is to accept the client's explanation at face value and proceed without further inquiry or escalation. While the client may be truthful, the regulatory framework requires a proactive approach to risk assessment. Circumventing internal procedures, even with a plausible explanation, undermines the institution's risk management framework and can be interpreted as a willful disregard for compliance obligations. A third incorrect approach is to document the client's explanation but not escalate it to compliance. While documentation is important, it is insufficient if it does not lead to appropriate action. The failure to involve the compliance department means that the potential risks associated with the incomplete documentation are not properly assessed or mitigated, leaving the institution exposed. Professional reasoning. Professionals in the financial services industry must adopt a risk-based approach to compliance. When faced with a situation that deviates from standard procedures, especially when it involves client onboarding or transaction monitoring, the immediate step should be to consult internal policies and procedures. If there is any ambiguity or potential for non-compliance, escalation to the relevant department, e.g., compliance, legal, risk management, is paramount. This ensures that decisions are made with a full understanding of the regulatory landscape and institutional risk appetite. Professionals should always prioritize adherence to regulations and ethical standards over expediency, as the long-term consequences of non-compliance far outweigh any short-term benefits. Question 12. The assessment process reveals that a new digital lending platform is being considered for launch. The proposed platform aims to streamline loan applications and approvals, targeting a younger demographic with innovative features. While initial projections show significant revenue potential, the assessment team needs to determine the most appropriate approach to evaluating the associated risks before the product goes live. Option A. Conduct a comprehensive risk assessment that identifies potential operational, compliance, reputational, and strategic risks, evaluates their likelihood and impact, and proposes mitigation strategies tailored to the platform's unique features and target market. Option B. Analyze historical performance data from existing but fundamentally different loan products to infer the risk profile of the new digital platform, without conducting specific assessments for its novel functionalities. Option C. Prioritize rapid deployment of the platform to capture first-mover advantage, with a minimal risk assessment focused only on immediate technical vulnerabilities, deferring a broader risk review until after the initial launch phase. Option D. Focus primarily on the projected revenue growth and market share gains, assuming that any emerging risks can be addressed reactively once the platform is operational and generating income. The correct answer is A. Conduct a comprehensive risk assessment that identifies potential operational, compliance, reputational, and strategic risks, evaluates their likelihood and impact, and proposes mitigation strategies tailored to the platform's unique features and target market. Explanation. This scenario presents a professional challenge because it requires an individual to move beyond a superficial understanding of risk assessment and apply it to a dynamic, real-world situation involving a new product launch. The challenge lies in identifying potential risks that are not immediately obvious and considering their downstream impact on the firm and its customers, all while adhering to regulatory expectations for robust risk management. Careful judgment is required to balance innovation with prudence, ensuring that the firm's risk appetite is not exceeded. The correct approach represents best professional practice because it demonstrates a proactive and comprehensive risk assessment methodology. It involves identifying potential risks across various categories: operational, compliance, reputational, strategic, assessing their likelihood and impact, and then developing appropriate mitigation strategies. This aligns with the principles of sound risk management expected by regulators, such as those outlined by the OCC Office of the Comptroller of the Currency, for national banks, which emphasize a risk-based approach to identifying, measuring, monitoring, and controlling risks. Specifically, it reflects the expectation that institutions will have processes in place to understand the risks associated with new products and services before they are introduced to the market. An incorrect approach that focuses solely on the immediate financial projections of the new product fails to consider the broader spectrum of risks. This oversight could lead to regulatory violations related to inadequate risk management frameworks, as regulators expect a holistic view of potential downsides, not just upside potential. Another incorrect approach that prioritizes speed to market over thorough risk analysis is ethically problematic and could result in reputational damage and customer harm if unforeseen issues arise. This violates the ethical duty to act with due diligence and care. A third incorrect approach that relies on historical data from dissimilar products ignores the unique characteristics and potential risks of the new offering, demonstrating a lack of critical thinking and potentially leading to a failure to identify novel risks, which is a direct contravention of the principle of continuous risk assessment and adaptation. Professionals should employ a decision-making framework that begins with understanding the business objective, then systematically identifying all potential risks associated with achieving that objective. This involves brainstorming, consulting with subject matter experts, and considering various risk categories. Once risks are identified, they should be analyzed for their potential impact and likelihood. Mitigation strategies should then be developed and implemented, with ongoing monitoring to ensure their effectiveness. This iterative process ensures that risk management is integrated into the business strategy rather than being an afterthought. Question 13. Strategic planning requires a thorough understanding of potential threats to the firm's objectives. When assessing risks for a new product launch, which approach best aligns with the principles of sound risk management and regulatory expectations for a U.S. financial institution? Option A. Prioritizing risks based on a combination of their likelihood of occurrence and their potential severity of impact on the firm's financial stability and strategic goals. Option B. Deferring the assessment of reputational risks until after the product has been launched and initial customer feedback is received. Option C. Addressing only those risks that are easily quantifiable and have a direct, immediate financial cost. Option D. Focusing exclusively on risks that have materialized in similar product launches at competitor institutions. The correct answer is A. Prioritizing risks based on a combination of their likelihood of occurrence and their potential severity of impact on the firm's financial stability and strategic goals. Explanation. This scenario presents a professional challenge because it requires a nuanced understanding of risk assessment beyond simple identification. The challenge lies in prioritizing risks based on their potential impact and likelihood, and then aligning those priorities with the firm's strategic objectives and risk appetite, all within the strict confines of U.S. banking regulations. A robust risk assessment is not merely a checklist, but a dynamic process that informs decision-making and resource allocation. The correct approach represents best professional practice because it involves a comprehensive evaluation of potential risks, considering both their probability and potential severity, and then mapping these to the firm's strategic goals. This aligns with the principles of sound risk management expected by U.S. banking regulators, such as those outlined by the Federal Reserve and OCC, which emphasize proactive identification, assessment, and mitigation of risks that could impact the safety and soundness of the institution. It demonstrates a commitment to understanding the firm's risk profile and making informed decisions that support long-term stability and compliance. An incorrect approach that focuses solely on the most frequently occurring risks fails to acknowledge that low-frequency, high-impact events can be catastrophic. This overlooks the regulatory expectation to consider tail risks and systemic vulnerabilities. Another incorrect approach that prioritizes risks based on immediate operational convenience, without considering their strategic implications or potential for regulatory scrutiny, is also professionally unacceptable. This demonstrates a lack of foresight and a failure to integrate risk management into the broader business strategy, which can lead to significant compliance issues and financial losses. Furthermore, an approach that ignores potential reputational damage, even if financial impact is perceived as low, is flawed. Regulators increasingly view reputational risk as a critical component of overall risk management, as it can have far-reaching consequences for customer trust and market standing. The professional decision-making process for similar situations should involve a structured risk assessment framework that includes 1. Risk identification, brainstorming all potential risks across various categories: operational, credit, market, compliance, strategic, reputational. 2. Risk analysis, evaluating the likelihood and impact of each identified risk. 3. Risk evaluation, prioritizing risks based on their significance relative to the firm's risk appetite and strategic objectives. 4. Risk treatment, developing and implementing strategies to mitigate, transfer, accept, or avoid prioritized risks. 5. Risk monitoring and review, continuously tracking identified risks and reassessing the risk landscape. This iterative process ensures that risk management remains relevant and effective in a constantly evolving environment. Question 14. Operational review demonstrates that the firm's current approach to risk assessment primarily relies on analyzing past incident data to identify potential vulnerabilities. While this has been effective in addressing historical issues, there is a growing concern that emerging cyber threats and evolving market dynamics are not being adequately captured. Which of the following approaches best addresses this gap and aligns with robust risk management principles? Option A. Increase the frequency of historical incident data analysis to identify any subtle trends that may indicate emerging risks without introducing new assessment methodologies. Option B. Implement a forward-looking risk assessment framework that incorporates scenario analysis, threat intelligence feeds, and expert judgment to proactively identify and evaluate potential future risks, alongside historical data analysis. Option C. Focus solely on the cost-effectiveness of existing controls, assuming that any new risks will be minor and manageable with current resources. Option D. Delegate the entire risk assessment process to an external compliance vendor with minimal internal oversight to ensure adherence to regulatory checklists. The correct answer is B. Implement a forward-looking risk assessment framework that incorporates scenario analysis, threat intelligence feeds, and expert judgment to proactively identify and evaluate potential future risks, alongside historical data analysis. Explanation: scenario analysis. This scenario is professionally challenging because it requires balancing the need for efficient risk mitigation with the potential for over-reliance on automated systems, which may not capture nuanced or emerging risks. The challenge lies in ensuring that the risk assessment process remains dynamic and responsive to evolving threats, rather than becoming a static, checklist-driven exercise. A key difficulty is distinguishing between genuine risk reduction and mere compliance-driven activity. Correct approach analysis. The correct approach represents best professional practice because it emphasizes a continuous, iterative process of risk identification, assessment, and mitigation. This aligns with regulatory expectations, such as those found in the U.S. banking framework, e.g., OCC, Federal Reserve Guidance on Risk Management, which mandate robust and ongoing risk assessment. It promotes a proactive stance, encouraging the integration of new information and the adaptation of controls. This approach fosters a culture of risk awareness and accountability throughout the organization, ensuring that risk management is embedded in business processes, not an afterthought. Incorrect approaches analysis. One incorrect approach fails by solely relying on historical data. This is professionally unacceptable because it ignores emerging risks and new threat vectors that have not yet manifested in past incidents. Regulatory frameworks, like those from the SEC or FINRA concerning cybersecurity and operational risk, stress the importance of forward-looking risk assessment and the need to anticipate future vulnerabilities. This approach can lead to a false sense of security and leave the organization exposed to novel threats. Another incorrect approach is to focus exclusively on the cost of implementing controls without a thorough assessment of the potential impact of the risks themselves. This is a regulatory and ethical failure, as it prioritizes financial expediency over the safety and soundness of the institution and its customers. U.S. banking regulations, for instance, require risk assessments to consider both the likelihood and the impact of potential events, ensuring that resources are allocated to address the most significant threats. This approach risks under-resourcing critical controls, leading to potential financial losses, reputational damage, and regulatory penalties. A third incorrect approach involves treating risk assessment as a purely compliance exercise, disconnected from business strategy. This is professionally unsound and ethically questionable. While compliance is a component, effective risk management should inform strategic decision-making. Regulatory bodies expect risk assessments to be integrated into business planning, not performed in isolation. This approach can lead to the implementation of controls that are technically compliant but ineffective in mitigating actual business risks, potentially violating the spirit, if not the letter, of regulatory intent. Professional reasoning. Professionals should adopt a decision-making framework that prioritizes a holistic and dynamic approach to risk assessment. This involves 1. Understanding the business objectives and the inherent risks associated with achieving them. 2. Employing a variety of assessment methodologies, including scenario analysis, threat intelligence, and expert judgment, to identify both known and emerging risks. 3. Quantifying and qualifying risks based on their potential impact and likelihood. 4. Developing and implementing proportionate controls with a clear understanding of their effectiveness and cost-benefit. 5. Establishing a robust monitoring and review process to ensure controls remain effective and to adapt to changes in the risk landscape. This iterative process, grounded in regulatory expectations and ethical principles, ensures that risk management is a strategic enabler rather than a bureaucratic burden. Question 15. Operational review demonstrates a recurring pattern of minor data entry errors in a specific category of customer service requests, leading to slight delays in processing. While these errors have not resulted in significant financial losses or major customer complaints, they indicate a potential weakness in the current data input controls for this process. What is the most appropriate next step for the risk management team? Option A. Classify the findings as minor operational noise and take no further action, assuming they will resolve themselves. Option B. Immediately escalate the issue to senior management for a complete system overhaul of the customer service request platform. Option C. Implement enhanced monitoring and targeted training for personnel involved in processing these specific transaction types. Option D. Introduce a blanket policy requiring manual re-verification of all customer service requests, regardless of category. The correct answer is C. Implement enhanced monitoring and targeted training for personnel involved in processing these specific transaction types. Explanation. Scenario analysis. This scenario is professionally challenging because it requires balancing the need for efficient risk mitigation with the potential for unintended consequences that could impact customer service or operational integrity. The risk manager must exercise sound judgment to identify the most effective and compliant approach without overreacting or underestimating the identified risk. The challenge lies in selecting a solution that is both robust in addressing the risk and practical in its implementation within the Wells Fargo operational framework. Correct approach analysis. The correct approach represents best professional practice because it directly addresses the identified operational risk through a targeted and proportionate control enhancement. Implementing enhanced monitoring and reporting for specific transaction types that have shown a pattern of errors aligns with regulatory expectations for robust risk management. This approach is proactive, data-driven, and focuses on improving the accuracy and reliability of critical processes, thereby reducing the likelihood of future errors and potential customer impact. It demonstrates a commitment to continuous improvement and adherence to internal policies and external regulations governing operational risk. Incorrect approach is analysis. One incorrect approach involves immediately escalating the issue to senior management for a complete overhaul of the system. This is professionally unacceptable because it bypasses standard risk management protocols for assessing and addressing operational issues. It can lead to unnecessary panic, resource misallocation, and potentially disruptive changes without a thorough understanding of the root cause or the feasibility of less drastic solutions. This approach fails to demonstrate a systematic and measured response to risk. Another incorrect approach is to dismiss the findings as isolated incidents with minimal impact. This is professionally unacceptable, as it demonstrates a failure to recognize and address potential systemic weaknesses or emerging risks. Regulatory bodies, including those overseeing Wells Fargo, expect proactive identification and mitigation of risks, even those that appear minor initially. Ignoring such findings can lead to a pattern of errors, customer dissatisfaction, and ultimately, significant regulatory scrutiny and penalties. A third incorrect approach is to implement a broad, sweeping change across all transaction types without specific analysis. This is professionally unacceptable because it is inefficient and potentially disruptive. It fails to demonstrate a targeted risk assessment and control design. Such an approach expends resources unnecessarily and may introduce new risks or operational inefficiencies without a clear justification based on the specific risk identified. It lacks the precision and proportionality expected in effective risk management. Professional reasoning. Professionals should employ a structured decision-making process that begins with a thorough understanding of the operational review findings. This involves identifying the specific nature and potential impact of the risk. Next, they should evaluate potential control enhancements, considering their effectiveness, efficiency, and alignment with regulatory requirements and business objectives. The process should involve data analysis to support the chosen course of action and a clear rationale for why it is the most appropriate response. Finally, professionals must document their assessment and the chosen mitigation strategy, ensuring transparency and accountability. Question 16. System analysis indicates that a new digital lending product, designed to offer faster loan approvals, has been developed by the innovation team. While initial projections show significant revenue potential, the product utilizes a novel algorithm for credit scoring that has not been fully tested for bias or operational resilience under extreme market conditions. The risk management department has raised concerns about potential regulatory compliance issues related to fair lending practices and operational disruptions. What is the most appropriate course of action for the firm's risk assessment process? Option A. Halt all development and exploration of the product indefinitely until the risk management department can provide absolute certainty that no potential risks exist. Option B. Proceed with a limited pilot launch in a controlled environment, contingent upon the development and approval of a comprehensive risk mitigation plan addressing identified concerns, including enhanced monitoring and clear escalation protocols. Option C. Authorize the product development team to conduct their own final risk assessment and implement any necessary controls without further independent review from the risk management department. Option D. Launch the product immediately to capitalize on market demand, with a commitment to address any emerging risks and compliance issues on a reactive basis. The correct answer is B. Proceed with a limited pilot launch in a controlled environment, contingent upon the development and approval of a comprehensive risk mitigation plan addressing identified concerns, including enhanced monitoring and clear escalation protocols. Explanation. Scenario analysis. This scenario presents a common challenge in risk assessment where a new product, while potentially profitable, introduces novel operational and compliance risks that are not fully understood. The pressure to innovate and capture market share can create a conflict with the imperative to conduct thorough due diligence. The professional's responsibility is to balance business objectives with the need to protect the firm and its clients from undue risk, adhering strictly to regulatory expectations for risk management. Correct approach analysis. The correct approach involves a phased risk assessment and mitigation strategy. This aligns with best practices mandated by U.S. banking regulations, such as those from the Office of the Comptroller of the Currency (OCC) and the Federal Reserve, which emphasize a robust risk management framework. This framework requires identifying, assessing, and controlling risks before launching new products or services. Specifically, it necessitates understanding the product's life cycle, potential vulnerabilities, and the adequacy of existing controls. Developing a comprehensive risk mitigation plan, including enhanced monitoring and clear escalation procedures, demonstrates proactive risk management and compliance with regulatory expectations for operational resilience and consumer protection. This approach ensures that risks are managed within the firm's risk appetite and that the product launch is sustainable and compliant. Incorrect approach is analysis. One incorrect approach involves proceeding with the launch based on preliminary risk assessments without a comprehensive mitigation plan. This violates regulatory requirements for thorough risk assessment and control implementation prior to product rollout. It exposes the firm to significant operational, compliance, and reputational risks, potentially leading to regulatory scrutiny, fines, and customer harm. This demonstrates a failure to adhere to the principles of sound risk management as outlined by U.S. banking regulators. Another incorrect approach is to delay the launch indefinitely due to perceived, but unquantified, risks. While caution is important, an indefinite delay without a structured plan to address identified concerns can stifle innovation and lead to missed business opportunities. More importantly, it fails to engage in a constructive risk management process that seeks to understand and mitigate risks to an acceptable level, rather than simply avoiding them. This can be seen as a failure to effectively manage risk within the firm's stated risk appetite. A third incorrect approach is to delegate the entire risk assessment to the product development team without independent oversight or validation. This creates a conflict of interest and undermines the integrity of the risk assessment process. Regulatory bodies expect independent risk management function to provide objective assessments and challenge business units. This approach bypasses crucial checks and balances, increasing the likelihood of overlooked risks and noncompliance. Professional reasoning. Professionals should adopt a structured, iterative approach to risk assessment for new products. This involves 1. Initial identification of potential risks across operational, compliance, legal, and reputational categories. 2. Detailed assessment of the likelihood and impact of identified risks. 3. Development of specific actionable mitigation strategies and controls. 4. Establishment of monitoring mechanisms and key risk indicators. 5. Independent validation of the risk assessment and mitigation plan. 6. Phased rollout with ongoing review and adjustment. This process ensures that business objectives are pursued responsibly and in compliance with all applicable regulations. Question 17. The efficiency study reveals that the current risk assessment process for new product launches is taking longer than anticipated. To expedite this, the risk management team is considering several adjustments. Which of the following approaches best aligns with regulatory expectations for a robust and compliant risk assessment framework in the U.S. banking sector? Option A. Delegate the entire risk assessment process to junior analysts to increase throughput, with minimal senior management oversight. Option B. Integrate qualitative expert judgment from experienced business line managers and compliance officers with quantitative data analysis to form a comprehensive risk profile. Option C. Focus solely on the speed of assessment, prioritizing the completion of the risk report within a reduced time frame, even if it means omitting certain risk categories. Option D. Significantly reduce the scope of qualitative risk reviews and rely primarily on historical quantitative data to predict potential risks. The correct answer is B. Integrate qualitative expert judgment from experienced business line managers and compliance officers with quantitative data analysis to form a comprehensive risk profile. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires balancing the need for efficient risk assessment with the imperative to adhere to regulatory requirements and ethical standards. The pressure to streamline processes, as indicated by the efficiency study, could tempt a risk manager to overlook crucial qualitative factors or rely solely on quantitative data, potentially leading to an incomplete or inaccurate risk profile. Careful judgment is required to ensure that efficiency gains do not compromise the thoroughness and integrity of the risk assessment process. Correct approach analysis. The correct approach, which involves integrating qualitative expert judgment with quantitative data analysis, represents best professional practice because it aligns with the principles of sound risk management as mandated by U.S. banking regulations. Regulatory bodies like the Federal Reserve and the Office of the Comptroller of the Currency (OCC) emphasize a holistic approach to risk assessment that considers both measurable data and the nuanced insights of experienced personnel. This integrated method ensures that the risk assessment captures a comprehensive view of potential threats, including those that may not be easily quantifiable, but are recognized by those with deep industry and operational knowledge. This approach directly supports the regulatory expectation of robust internal controls and effective risk management frameworks designed to protect the institution and its customers. Incorrect approaches analysis. One incorrect approach would be to solely rely on historical quantitative data to predict future risks. This fails to account for emerging risks, changes in market conditions, or unique operational vulnerabilities that are not reflected in past data. This approach is ethically problematic as it can lead to underestimation of risk, potentially exposing the firm to losses and regulatory sanctions for inadequate risk management, violating the spirit of prudent risk oversight. Another incorrect approach would be to prioritize speed and cost reduction in the risk assessment process by significantly reducing the scope of qualitative review. This could lead to overlooking critical non-quantifiable risks such as reputational damage, compliance breaches due to evolving regulations, or strategic misalignments. Such an approach would be a direct violation of regulatory expectations for a comprehensive and thorough risk assessment, potentially resulting in fines and increased supervisory scrutiny. A third incorrect approach would be to delegate the entire risk assessment process to junior staff without adequate senior oversight or validation. While efficiency might be a perceived benefit, this can lead to errors in judgment, misinterpretation of data, and a lack of understanding of the broader business context. This failure in oversight is a significant ethical and regulatory lapse, as senior management is ultimately responsible for the effectiveness of the firm's risk management systems. Professional reasoning. Professionals should approach risk assessment by first understanding the specific regulatory expectations for their institution and jurisdiction. This involves identifying all relevant quantitative and qualitative data sources. The decision-making process should then involve a structured methodology that integrates these sources, allowing for expert judgment to inform and refine the quantitative findings. Regular review and validation by experienced personnel and senior management are crucial to ensure the accuracy and completeness of the risk assessment. When efficiency is a goal, it should be pursued through process optimization and technological enhancements that support, rather than undermine, the quality and comprehensiveness of the risk assessment. Question 18. The control framework reveals that a new client, identified as potentially high risk due to their business activities in a jurisdiction with known corruption issues, has provided incomplete documentation for account opening. The business development manager is pushing to open the account quickly to meet quarterly targets, suggesting that the missing information can be collected post-onboarding. What is the most appropriate course of action to ensure compliance with U.S. anti-money laundering (AML) regulations? Option A. Decline to open the account until all required due diligence documentation is fully completed and verified, in accordance with the Bank Secrecy Act and FinCEN guidance. Option B. Open the account based on the client's self-certification of their source of funds and beneficial ownership, deferring independent verification until a later date. Option C. Authorize a junior compliance officer to review and approve the account opening with the understanding that the missing documentation will be addressed by the business development manager. Option D. Proceed with opening the account, accepting the incomplete documentation, and initiating a follow-up process to obtain the missing information within 30 days. The correct answer is A. Decline to open the account until all required due diligence documentation is fully completed and verified, in accordance with the Bank Secrecy Act and FinCEN guidance. Explanation. Scenario analysis. This scenario presents a challenge in balancing the need for efficient client onboarding with the imperative to adhere to stringent anti-money laundering (AML) regulations. The pressure to meet business targets can create a temptation to bypass or expedite certain due diligence steps, which is a common pitfall in financial institutions. The professional challenge lies in recognizing the inherent risks associated with incomplete Know Your Customer (KIC) procedures, and understanding that regulatory noncompliance can lead to severe penalties, reputational damage, and loss of trust. Correct approach analysis. The correct approach prioritizes thorough customer due diligence (CDD), as mandated by the Bank Secrecy Act (BSA), and its implementing regulations, such as those enforced by the Financial Crimes Enforcement Network (FinCEN). Best professional practice dictates that all required documentation and verification steps must be completed before a new account is opened, regardless of business pressure. This aligns with the risk-based approach framework, which requires financial institutions to identify, assess, and mitigate money laundering and terrorist financing risks. Failing to conduct adequate CDD is a direct violation of these regulations, as it leaves the institution vulnerable to facilitating illicit financial activities. Incorrect approaches analysis, an approach that expedites account opening by accepting incomplete documentation with the intention of obtaining the missing information later, fails to meet the minimum CDD requirements. This is a regulatory failure because the BSA and FinCEN regulations require that CDD be performed before establishing a customer relationship. It creates a significant AML risk by allowing potentially suspicious individuals or entities to access the financial system without proper scrutiny. Ethically, it demonstrates a disregard for the institution's responsibility to prevent financial crime. Another incorrect approach might involve relying solely on a client's self-certification without independent verification of critical information, such as source of funds or beneficial ownership. This is a regulatory failure because it bypasses essential verification steps designed to confirm the accuracy and legitimacy of the client's information. It increases the risk of onboarding individuals involved in money laundering or other illicit activities, as their self-declarations may be false. A third incorrect approach could be to delegate the final CDD sign-off to a junior staff member without adequate oversight or training, especially when dealing with high-risk clients. This is a regulatory and ethical failure, as it undermines the integrity of the control framework. The BSA and FinCEN guidance emphasize the importance of experienced personnel and robust internal controls in the AML compliance program. Delegating critical decision-making without proper authority or expertise can lead to oversight and a failure to identify red flags, thereby increasing the institution's exposure to financial crime. Professional reasoning. Professionals should adopt a decision-making process that begins with a clear understanding of the regulatory requirements and the institution's internal policies. When faced with pressure to deviate from these standards, the professional should first identify the specific regulatory mandate being compromised. Next, they should assess the potential risks, both regulatory and reputational, associated with noncompliance. The professional should then communicate these risks clearly to their superiors, highlighting the potential consequences of the proposed shortcut. The decision should always be to adhere to the established procedures and regulations, seeking guidance or escalation if the pressure to compromise persists. This ensures that client relationships are established responsibly and in full compliance with the law. Question 19. Cost-benefit analysis shows that implementing a new AI-driven customer service platform could significantly reduce operational expenses and improve response times, but it also introduces novel cybersecurity vulnerabilities and requires extensive data integration from legacy systems. Which approach best balances potential gains with responsible implementation? Option A. Proceed with immediate full-scale implementation to capture the cost savings as quickly as possible, assuming that any emergent issues can be addressed reactively. Option B. Implement the AI platform with minimal upfront security checks, focusing solely on the projected cost reductions and assuming vendors will manage all associated risks. Option C. Delay the implementation indefinitely due to the identified cybersecurity risks and data integration complexities, opting to maintain existing, less efficient systems. Option D. Prioritize the implementation of the AI platform after a thorough risk assessment, including penetration testing and a review of data privacy protocols, with a phased rollout to monitor performance and address emergent issues. Correct answer is D. Prioritize the implementation of the AI platform after a thorough risk assessment, including penetration testing and a review of data privacy protocols, with a phased rollout to monitor performance and address emergent issues. Explanation. This scenario presents a professional challenge because it requires balancing the potential for increased efficiency and profitability against the inherent risks associated with adopting new, unproven technologies. The pressure to innovate and remain competitive in the financial services industry can lead to hasty decisions if not tempered by a rigorous evaluation process. Careful judgment is required to ensure that the chosen technology aligns with Wells Fargo's strategic objectives, risk appetite, and regulatory obligations, particularly concerning data security and customer privacy. The correct approach represents best professional practice because it prioritizes a comprehensive, multifaceted evaluation that extends beyond immediate cost savings. It involves a thorough assessment of potential benefits, e.g., improved customer experience, operational efficiency, and a detailed analysis of associated risks, e.g., cybersecurity threats, data breaches, regulatory noncompliance, integration challenges. This approach aligns with the principles of prudent risk management and ethical conduct expected of financial institutions. Specifically, it adheres to regulatory frameworks that mandate robust risk assessments, due diligence on third-party vendors, and the protection of customer data, such as those enforced by the Office of the Comptroller of the Currency (OCC) and the Consumer Financial Protection Bureau (CFPB). In the U.S., by considering long-term implications and potential unintended consequences, this approach fosters sustainable growth and maintains stakeholder trust. An incorrect approach that focuses solely on the immediate cost savings without adequately assessing the associated risks represents a significant regulatory and ethical failure. This could lead to violations of data privacy laws, e.g., Gramm-Leach-Bliley Act and consumer protection regulations, resulting in substantial fines, reputational damage, and loss of customer confidence. Another incorrect approach that prioritizes speed of implementation over thorough testing and validation would expose the institution to operational disruptions and potential security vulnerabilities, contravening the regulatory expectation for sound operational risk management and business continuity planning. Furthermore, an approach that neglects to consider the ethical implications of data usage or potential biases within the new technology would violate ethical principles and potentially lead to discriminatory outcomes, which are increasingly scrutinized by regulators. The professional decision-making process for similar situations should involve a structured framework that includes clearly defining the problem or opportunity, identifying all relevant stakeholders, gathering comprehensive data on potential benefits and risks, consulting with subject matter experts, e.g., legal, compliance, IT security, risk management, evaluating alternatives against predefined criteria, and documenting the decision-making process and rationale. This iterative process ensures that decisions are informed, defensible, and aligned with the organization's values and regulatory obligations. Question 20. Compliance review shows that a financial advisor is working with a new client who has expressed a strong desire to achieve aggressive growth in their portfolio, aiming for 20% annual return. However, during the initial fact-finding process, the client also indicated a very low tolerance for market volatility and a need for capital preservation due to upcoming financial obligations. The advisor has noted this discrepancy in the client's profile. Which of the following represents the most appropriate next step for the advisor to take? Option A. Immediately proceed with recommending a portfolio heavily weighted towards high growth, potentially volatile assets to meet the client's stated 20% return objective, assuming the client understands the associated risks. Option B. Document the conflicting information in the client's file, but proceed with a moderate investment strategy, assuming the client will eventually adjust their expectations. Option C. Inform the client that their stated objective is incompatible with their risk tolerance and financial obligations, and refuse to proceed with managing their portfolio. Option D. Engage in a detailed discussion with the client to explore the underlying reasons for their aggressive growth objective and their specific concerns about volatility, aiming to identify investment strategies that balance their stated goals with their risk tolerance and financial situation. The correct answer is D. Engage in a detailed discussion with the client to explore the underlying reasons for their aggressive growth objective and their specific concerns about volatility, aiming to identify investment strategies that balance their stated goals with their risk tolerance and financial situation. Explanation. Scenario analysis. This scenario presents a common challenge in financial services where a client's stated investment objective appears to conflict with their risk tolerance and financial situation. The challenge lies in balancing the client's expressed desires with the advisor's fiduciary duty to act in the client's best interest, ensuring suitability and avoiding undue risk. A failure to properly assess and address this discrepancy can lead to unsuitable recommendations, regulatory violations, and reputational damage for both the advisor and the firm. Correct approach analysis. The correct approach demonstrates a commitment to the client's best interest, a core principle under U.S. securities regulations and FINRA rules. It involves a thorough, documented process of understanding the client's complete financial picture, including their risk tolerance, financial situation, and investment objectives. By engaging in a detailed discussion to reconcile the stated objective with the client's capacity for risk, the advisor ensures that any recommendation is suitable and aligned with the client's overall financial well-being. This proactive, investigative approach is essential for fulfilling fiduciary responsibilities and adhering to suitability standards. Incorrect approaches analysis. One incorrect approach involves immediately proceeding with the client's stated objective without further inquiry. This fails to uphold the advisor's duty to assess suitability and act in the client's best interest. It prioritizes the client's immediate request over a comprehensive understanding of their needs and risk capacity, potentially leading to recommendations that are too aggressive or inappropriate for their financial circumstances, violating FINRA Rule 2111. Suitability. Another incorrect approach is to dismiss the client's stated objective outright and impose the advisor's own judgment without attempting to understand the client's rationale or explore potential compromises. This demonstrates a lack of client centricity and can be perceived as patronizing or dismissive, undermining the trust essential in an advisory relationship. It also fails to explore if the stated objective, while perhaps ambitious, could be achieved through a modified strategy that aligns with the client's risk tolerance. A third incorrect approach is to document the discrepancy but take no further action to address it with the client. This creates a compliance record but does not fulfill the ethical or regulatory obligation to ensure suitability. The firm and advisor remain exposed to risk if an unsuitable recommendation is made based on an unaddressed conflict between stated objectives and risk tolerance. Professional reasoning. Professionals should adopt a client-first mindset, prioritizing a deep understanding of the client's financial situation, risk tolerance, and objectives. When discrepancies arise, the professional approach involves open communication, thorough investigation, and collaborative problem-solving to find suitable solutions. Documentation of these discussions and decisions is crucial for demonstrating compliance and ethical conduct. The process should be iterative, ensuring that recommendations are consistently aligned with the client's evolving needs and capacity.